Let's get straight to the data. The single most important thing for gold buyers to understand this week is the disconnect between what's happening in COMEX registered inventory and what spot price is telling you. In this video, I'll show you the exact numbers, explain what's driving this divergence, and give you my clear view, bullish or bearish, for the next 7 to 10 days. First, here's the hard evidence. COMEX registered gold inventory, the gold available for immediate delivery, dropped from 8.9 million ounces on January 28th to 8.2 million ounces as of February 12th. That's a 7.9% draw in 2 weeks. This is not a collapse, but it's significant because it's happening during a period when spot gold has held a tight range between 2,920 and 2,965. Second data point. Physical premiums. American Gold Eagles are currently trading at 6.8% to 7.2% over spot at major online dealers. That's up from 5.5% in mid-January. Gold Buffaloes are at 4.9% to 5.3%, also elevated from their 30-day average of 4.1%. These aren't panic premiums, but they're moving in the wrong direction if you believe demand is cooling. Third, open interest on COMEX gold futures. As of yesterday's report, open interest sits at 512,000 contracts. That's roughly 51.2 million ounces of paper gold exposure. Compare that to the 8.2 million ounces of registered physical, and you're looking at a 6.2 to 1 ratio. Again, this is not unusual for COMEX, but the ratio has widened from 5.4 to 1 just 4 weeks ago. What this data normally means is simple. When registered inventory falls while open interest holds steady or rises, the market is either seeing stronger physical offtake or weaker willingness from vault holders to make gold available for delivery. Both scenarios typically precede price strength, not weakness. So, what's actually happening here? The primary driver is post-Fed positioning. The Federal Reserve held rates steady at its February 5th meeting, which was expected, but the language in the statement shifted slightly more hawkish than January, citing persistent inflation pressures and removing the phrase additional progress when describing the path toward the 2% target. That language matters because it pushed the 10-year Treasury yield from 4.48% on February 4th to 4.61% by February 10th. Here's the key. Gold didn't break down. Normally, when real yields rise, meaning nominal yields climb faster than inflation expectations, gold faces headwinds, but spot gold only dipped to $2,920 intraday on February 7th before recovering to current levels near $2,950. That's a 1% pullback on a 13 basis point move in real yields. That ratio tells me physical demand is absorbing paper market pressure. Now compare this to what happened in November 2024. After the presidential election, the 10-year yield spiked 28 basis points in 5 days, and gold dropped 4.2% from 2,585 to 2,668. The November reaction was clean and predictable. The February reaction is muted. Why? The answer is visible in the data I just showed you. Registered inventory is being drawn at a pace that suggests strong physical conversion. When futures holders stand for delivery instead of rolling contracts forward, it removes flexible supply from the system. The 8.2 million ounce level is not a crisis, but it's the lowest registered inventory since October 2024, and we're heading into a March delivery month. March, June, and December are historically the 3 highest volume delivery months on COMEX. One more point of divergence, look at gold miners. The GDX Gold Miner ETF is up 2.1% over the past 5 trading days, even as the 10-year yield has stayed elevated. Miners typically lead or confirm gold price moves. When miners hold strength while yields rise, it signals market participants expect gold's next move to be higher, not lower. Here is what to watch and what to do. The scenario. The most likely outcome over the next 7 to 10 days is a test of $3,000 on spot gold. Here's why I'm confident in that call. First, if registered COMEX inventory continues to decline, and there's no reason to expect a reversal before the March delivery period closes, then physical tightness will pressure spot prices upward regardless of what the 10-year yield does. Second, if the February CPI print due February 12th at 8:30 a.m. Eastern comes in at or above 3.0% year over year, the market will reprice the Fed's rate path and gold will benefit from renewed haven demand. The key technical level to confirm this scenario is 2,965. That's the recent local high from February 3rd. A clean break and daily close above 2,965 opens the door to $3,000 within 5 trading sessions. If spot gold fails to hold 29 in 20s, That's the support level I mentioned earlier. Then we're looking at a retest of $2,880, and the bullish case weakens significantly. On the downside scenario, if yields continue climbing and the CPI print comes in below 2.8%, the market could interpret that as a reason to sell gold. In that case, registered inventory draw won't matter in the short term because paper market flows will dominate. But even in that scenario, I'd view it as a buying opportunity for physical holders, not a breakdown. Action plan. Here are 3 specific steps for you. 1. Monitor the COMEX Daily Gold Stocks Report, which posts every afternoon on the CME website. You're watching for continued declines in registered inventory. If we see registered drop below 8 million ounces before March 1st, that's a strong signal for physical tightness heading into delivery. Bookmark that page and check it once per day. 2. Track physical premiums on your preferred bullion dealer sites. I recommend checking APMEX, SD Bullion, and JM Bullion Daily for American Gold Eagle premiums. If premiums widen beyond 8% over spot, that confirms strong retail demand and validates the bullish case. If premiums compress back toward 5%, it suggests physical demand is cooling and the COMEX draw may be technical, not fundamental. 3. Set your buy levels now. If you're a physical stacker looking to add, my recommendation is to place limit orders for American Gold Eagles at $3,050 spot equivalent, which accounts for current premiums. That gives you a 3% cushion above the current market and ensures you're buying on strength, not chasing. If you're watching paper gold via GLD or futures, use $2,920 as your line in the sand. Below that level, wait for confirmation at $2,180 before committing. To recap, the data shows COMEX registered gold inventory down 7.9% in 2 weeks, physical premiums elevated and rising, and muted price response to higher real yields. The driver is likely post-Fed physical demand absorbing paper selling pressure. My view is bullish over the next 7 to 10 days with a target of $3,000 on spot gold. Your job is to watch the 2,165 breakout level and monitor registered inventory through month end. If this calm, data-driven approach is useful, subscribe. Let me know in the comments. Do you see this as a buying opportunity or a warning sign? Drop currency T below if you're positioned for higher prices. Stay disciplined. Trust the data. I'm T for currency T out.